Are you new to investing and worried about making mistakes? Welcome to the world of investing, a realm filled with promise but also fraught with potential pitfalls. The good news is, you're not alone. Every new investor faces a steep learning curve, and it's natural to make a few missteps along the way. But what if you could learn from the mistakes of others rather than making them yourself? In this video, we're going to delve into the 10 most common mistakes new investors make, from jumping headfirst into investments without sufficient research, to letting emotions dictate decisions, and even overlooking the impact of fees. We'll talk about the hazards of failing to diversify, the risks of chasing performance, and the importance of a clear investment strategy. We'll also discuss the need to rebalance your portfolio, the dangers of underestimating risk, and the tax implications of your investment decisions. So, sit tight as we uncover the 10 most common mistakes new investors make. The first pitfall is not doing enough research. Just as you wouldn't embark on a road trip without a map, you shouldn't dive into investing without understanding the terrain. The landscape of investing is vast and varied, from the broader market trends to the finer details of specific assets or companies. Without a solid grasp of these elements, you're essentially navigating in the dark. Consider this. Would you buy a house without investigating the neighborhood, the state of the property, or the local real estate market? Likely not. And yet, many new investors jump into financial commitments without a similar level of scrutiny. This can lead to poor decision-making, unforeseen risks, and ultimately, financial missteps. So before you make your move, take the time to study the market, delve into the specifics of potential assets, and get to know the ins and outs of the companies you are considering. Remember, knowledge is power when it comes to investing. The second mistake is failing to diversify. Imagine going to a casino and placing all your chips on a single number at the roulette table. Sure, you could hit the jackpot, but the odds are against you. That's essentially what you're doing when you put all your money into a single stock, sector, or asset class. You're betting everything on one outcome. The problem? The world of investing is unpredictable and full of surprises. If the market turns against your bet, you could lose everything. Now consider diversification. It's like spreading your chips across the table. You might not win as much if a single number hits, but you're also less likely to lose everything. Diversification is about spreading the risk and increasing your chances of success. It involves investing in a mix of assets that are likely to perform differently under various market conditions. So, don't put all your eggs in one basket. Thirdly, letting emotions drive your decisions. We're human. It's natural to feel the sting of loss more acutely than the joy of gain. But in the investing world, this emotional bias can be a pitfall. When we see our investments dip, panic can set in, leading us to sell at a low point. On the flip side, the thrill of a rising market can push us to buy more when prices are inflated. We call this buying high and selling low, and it's a surefire way to damage your investment growth. It's crucial to understand that markets fluctuate. They always have, and they always will. Instead of reacting to these short-term ups and downs, focus on the long-term trend and your overall investment strategy. Remember, investing isn't about making quick gains, it's about building wealth over time, so stay cool, calm, and collected when making investment decisions. The fourth mistake is ignoring fees. It's a common oversight, but one that can significantly impact your investment returns. There are several types of fees that can nibble away at your profits. First up are brokerage fees. These are the charges you pay to a broker for executing trades on your behalf. Then there are fund management fees. These are costs associated with the management and operation of a mutual fund or an exchange-traded fund. Last, but certainly not least, transaction costs. Each time you buy or sell a security, there's a charge involved, and these can add up quickly, especially if you're an active trader. The key point to remember is that these fees, while they may seem small and insignificant, can compound over time, eating into your returns. Think of it this way. The money you pay in fees is money that's not being invested and growing for your future. Every penny counts in investing, so don't ignore the fees. The fifth mistake is chasing performance. Picture this, a race car speeding past, leaving a trail of dust behind. It's easy to get caught in the excitement, the thrill of the chase, isn't it? But in investing, this chase can lead you off the track. Investing in something just because it's seen a recent run-up in price is like betting on that race car without knowing the driver's skill or the condition of the vehicle. It's crucial to remember past performance is not indicative of future results. Instead, consider the underlying fundamentals. What's driving the asset's growth? Is it sustainable? And what about the potential for future growth? Are there any indicators that this rally will continue? Or is it just a temporary surge? Chasing performance is a bit like chasing a mirage. It's often not what it seems, and it can lead you astray. So remember, don't chase the performance, analyze it. The sixth mistake is overlooking the importance of a plan. Imagine embarking on a journey without a map or a clear destination in mind. You're likely to wander aimlessly, right? The same principle applies to investing. Without a clear investment strategy or plan, you're sailing in uncharted waters. This can lead to scattered and inconsistent investment decisions, and ultimately, potential losses. An investment plan serves as your financial compass, guiding your decisions and helping you stay on course. It outlines your financial goals, risk tolerance, and investment timeline. This, in turn, informs the types of assets you should invest in and how much capital to allocate to each. When you're without a plan, you're more likely to be swayed by market rumors or trends, which can lead to impulsive and risky investment decisions. So before you start investing, take the time to develop a clear, comprehensive plan. Remember, a plan in hand is worth two in the bush. The seventh mistake is neglecting to rebalance. Imagine you're on a boat. You wouldn't want all the weight on one side, would you? The same principle applies to your investment portfolio. Regularly reviewing and adjusting your investments is like shifting weight on your boat to keep it stable. This process is called rebalancing. Rebalancing is essentially about ensuring your investments continue to align with your goals. It's like a tune-up for your portfolio. You adjust your investments based on changes in the market, your financial situation, or your investment goals. Now, if you ignore this essential task, your portfolio may drift from its original risk profile. For instance, if a particular stock in your portfolio has a stellar performance, it could become a larger portion of your portfolio than you initially intended. This could expose you to more risk than you're comfortable with. That's why it's crucial to keep your portfolio in balance. Always keep your portfolio in balance. The eighth mistake is underestimating risk. You've probably heard the phrase, no risk, no reward. It's a fundamental principle of investing, but it's also a double-edged sword. One edge can lead to great returns, while the other can lead to significant losses. The riskier the investment, the higher the potential returns, but also the higher the potential losses. In the world of investing, volatility is often used as a measure of risk. High volatility investments can swing wildly in value, both up and down. If you underestimate the risk and invest heavily in volatile assets, you may find yourself on an emotional roller coaster, experiencing the thrill of big gains one day and the despair of big losses the next. Moreover, if these losses are more than you can comfortably bear, it may lead to emotional distress and poor decision-making. Understanding your own risk tolerance is therefore crucial before diving into any investment. Remember, risk and reward go hand in hand in investing. The ninth mistake is ignoring taxes. Taxes are a crucial part of the investment equation that can significantly affect your net returns. Imagine this. You've made a good profit on your investments, but when tax time rolls around, you're hit with a hefty bill, diminishing your gains. To avoid this, consider the tax implications of your investment decisions from the get-go. For instance, using tax-advantaged accounts like individual retirement accounts or a 401k can offer you significant tax benefits. These accounts can either provide you with tax-free growth or allow for tax-deductible contributions. Furthermore, be aware of the impact of capital gains tax. This tax applies when you sell an investment at a profit. However, the rate of tax you pay can vary depending on how long you held the investment. In essence, understanding the tax implications can help you keep more of your investment returns in your pocket, rather than the taxman's. Don't let taxes take a bite out of your returns. The 10th and final mistake is a lack of patience. As with many things in life, investing is not a sprint, it's a marathon. The journey to financial growth is not an overnight sensation, but a gradual process that unfolds over time. It's about the long game, letting your investments mature, and reaping the rewards of your patience. Often, new investors get caught up in the allure of quick gains, but this can result in missing out on the benefits of compounding and long-term market gains. The magic of compounding is a powerful force that can significantly amplify your gains, but it requires time to work its wonders. Similarly, long-term market gains reward those who are patient enough to weather the storms of short-term volatility. By expecting immediate returns, you risk making hasty decisions that could damage your investment portfolio. So, let's remember, haste makes waste, especially in the world of investing. Patience is not just a virtue, it's an investor's best friend. So, those were the 10 most common mistakes new investors make. We've journeyed through the pitfalls of not doing enough research, the perils of failing to diversify, and the dangers of letting emotions drive decisions. We've also explored the often ignored fees that can eat into your returns, the risk of chasing performance, and the importance of having a clear investment strategy or plan. We've highlighted the need for periodic rebalancing to maintain your desired asset allocation, and the importance of properly assessing risk to avoid unexpected losses. We've looked at the tax implications of investment decisions, and the need for patience to allow investments time to grow. These are all critical factors to consider on your investment journey. Avoiding these common mistakes can significantly improve your chances of success, leading to a more stable and profitable investing experience. Remember, smart investing is about making informed and patient decisions. Happy investing!